So 2021 year in review. Once again, 2021 was dominated by the COVID-19 pandemic, and tax legislation was driven in large part responding to the crisis. In addition to the pandemic, tax policy was hampered by the current political environment and staffing issues at the IRS. Things have been really slow, basically, as far as the IRS goes, but the legislation and the changes have been pretty rapid. So in response to the crisis, Congress passed several major pieces of legislation in 2020 and in 2021. We're seeing more and more of that. All of them have pretty significant tax changes. In addition to major stimulus bills, there were still many unanswered questions about Trump's Tax Cuts and Jobs Act. And so you'll see some of those issues addressed in these, in the CARES Act and whatnot, making tweaks to the legislation from 2017. Very first thing, Families First Coronavirus Response Act. This was the first major piece of legislation signed into law March 18th, 2020, so directly after the pandemic started. And see, 9 days later, the CARES Act was there. So it was pretty quick. Signed into law March 27th to provide additional relief to those affected by COVID. A couple things on the CARES Act we're going to go through. This is all review for everybody, but provided stimulus of $1,200 per individual plus $500 for dependent children. There was a $300 above the line deduction for any charitable contributions, as long as you made at least $300. And that has, you'll see later in the slides, 2021 legislation actually bumped that up a little bit for married filing joint. So previously, there was an AGI limit for your charitable contributions. It was 50%. So if your AGI was $100,000, you could donate $50,000 and take that as a charitable contribution deduction, as a itemized deduction. If you contributed more than the 50, then it just got suspended and carried forward. But with this legislation, you were able to, if you made 100, if you had AGI of 100, you could donate 100 and net it out. Employee retention credit. This one's a big one. We're going to touch on this kind of as the presentation goes on. Each of the legislations added something to this. But at the very beginning, we established a tax credit available to employers that were shut down by a government order or had a reduction of at least 50% of your revenue based on the 2019 quarter, quarter one of 19 to quarter one of 20. And the credit was up to 50% of wages, limited to $10,000. It also allowed for early withdrawal of retirement funds that would not be subject to your 10% penalty. So if you're under 59.5 and pulled money out of your 401k, typically you'd get tagged an extra 10%. What this bill also did was allowed you to spread that taxable income over 3 years. So rather than paying tax on the 100 grand, you could opt in, if you met the qualifications, to pay tax on $33,333 a year for 3 years. Increase the loan amounts you're able to take out of your 401k up to $100,000. I don't see any people in here that maybe qualify for this, but if you're over the age of 72 and were required to take your minimum distributions, those got suspended. allowed employers to assist employees with college loan debt through tax-free payments up to $54.50. Made some changes to your flex spending accounts. Basically allowed for over-the-counter supplies to be qualified expenditure there. Okay, the Tax Cuts and Jobs Act limited business losses available to offset individuals' income to $50,000 of loss. The limitation was effective for years beginning after 2017, and the CARES Act deferred that to 2020. Tax Cuts and Jobs Act limited the use of NOLs to only offset 80% of your the taxpayer's other income. Additionally, it abolished any carrybacks of NOLs to prior years, and the CARES Act delayed that to years after 2020 as well. So that's another point. If you need to amend returns, now's the time to do it. Limited refunds of AMT credits. I won't bore you with that too much. Technical correction the CARES Act made. Tax Cuts and Jobs Act made a mistake in the definition of qualified improvement property on those 39-year assets, your commercial property. It limited depreciation on these to 39 years and did not allow bonus, but the CARES Act took care of that. And now you can have those be a 15-year asset and you can bonus those. So another opportunity to amend and get some cash back. Okay, so after the CARES Act, we had the Consolidated Appropriations Act of 2021. This was the Trump's final bill, basically. He signed this into law on December 27th, added many new tax provisions and amended several prior bills to even provide more relief for everybody. Another stimulus check, $600 per family member, including qualified children. If you did not receive these, you could get them as a credit on your tax return. So if you have not filed yet, which hopefully you have, you could potentially be eligible for these. We had a second draw of the PPP loans. The bill established the criteria for certain qualified borrowers to receive a second PPP loan as long as you use the first one for qualified expenses, and has no, you had to have less than 300 employees and demonstrate a 25% decline in revenue in comparable quarters. Now the CAA really came out and provided a lot of clarity on the PPP loans themselves. At the time we were doing planning in, late in 2020, we didn't know if they were going to be taxable or the expenses were going to be deductible or what was going to happen with this on the forgiveness part. So this really came out and said that the deductions were allowed and that it was not taxable. So it's honestly the biggest tax break I've ever seen. Just to not have to pay tax on free money and then also get to deduct the expenses, kind of double dipped. Also with these PPP funds, as a S Corp, we track your basis in that S Corp. We got to deduct the expenses. So then we got to add that PPP forgiveness back to your basis. So if you were to sell your business, you wouldn't have to pay capital gains on that difference. This bill also went on to provide the same treatment for other grants, such as the Economic Injury Disaster Loan, or EIDL, or EIDL, and other loan payment assistance provided by the CARES Act. The bill extended the refundable payroll tax credits for paid sick and family leave enacted by the FFCRA through the end of March 2021. And I'll skip that one. Okay, now we're back to the employee retention credit. So in the CAA, the bill changed the employee retention credit to 70% of the eligible compensation, up from the 50%, up to $10,000 through the second quarter of 2021. Additionally, it added flexibility by allowing employers to use funds in excess of PPP funds towards the credit, and reduces the requirement of revenue, decreased revenue from 50% down to 20%. So made it a lot easier for companies to qualify. Temporary allows 100% deduction for business meals as long as they're with a restaurant. So on your tax returns, you probably see a little adjustment on there. Throughout the year, you spend $20,000 in meals, and you only get to deduct $10,000 of it. For 2021, we'll actually get to deduct the full amount. Oh, and 2022.
What's the reason behind specifying the restaurant?
Pumping money into these people who have had a horrible time. I think it just, I guess any restaurant, and I think catering counts too. But yeah, if they serve food. Yeah, you got to be careful though. If in 2019 your meals and entertainment account was 10,000, and now all of a sudden it's 40,000 because you're just running everything through there. Might get looked at, I'm just saying. This is showing the increase. Previously, that $300 above the line deduction was for everybody, single, married. But now if you're married, you get an extra $300, which makes sense. Repeals Code Section 222 and eliminates the deduction for qualified tuition and related expenses, but in its place, increase the phase-out limit for your lifetime learning credit. Modified Section 401A to allow certain distributions of pension funds to participants who are over 59.5 but still working. And then for certain building and construction trades, the age is lowered to 55. Typically, your flex spending accounts are use it or lose it, but it allows them to be rolled from 2020 into 2021, so you don't lose that money that you put in those flex spending accounts. And then the CAA made a bunch of tax extenders. A couple of them were made permanent. A few of them extended an extra 5 years, 2 years, 1 year, etc. Medical expense deduction. So if you're an itemizer and you have high medical costs, typically it was limited to 10% of AGI, so if you had 100,000 of AGI, the first 10 grand was just out the window. You only got to deduct anything over that. Now it's down to 7.5%. So you're only losing out on 7,500. Code section 179D, energy efficient commercial buildings. That was extended and inflation adjusted going forward. Some more credits that were extended for 5 years. These are all on your handout, so I won't just like list them all out, but residential energy credits, basically extended for 2 years. You know, 3-year recovery for horse races or race horses.
What is that? Those are really different things.
Yeah. And many, many, many more. Joe Biden's in office, and American Rescue Plan Act of 2021 has happened. Child tax credit increase for 2021 only. Went up from when Trump made it 2,000, now it's 3,000. If you have kiddos under 6, you get an extra $600 for them. And these payments are paid half in advance unless you opted out by July 15th. So, you know, people are seeing these child tax credits being auto deposited into their accounts up front. And then at the end of 2021, when we do their tax returns, there will be potentially an adjustment if they were overpaid, if they were they had lower income in 2020 and were in the phase out range in 2021, but the credits being based on 2020, there'll be an adjustment on their returns. So they'll actually have to pay some of it back. Unlike the recovery rebate credits, which if they got them, even if they didn't qualify. Oh, and your qualified age went up to 17. So typically if a dependent turned 17 in that year, their credit was only $500. But now, as long as they don't turn 18 during the year, you get the full $3 grand. The employee retention credit got hit here again in a good way, extended through the end of 2021. So now you can claim it even if you receive PPP funds. 20% decrease in revenue still for the quarters in 2021. If this is something we haven't done yet, you can retroactively get these. All you have to do is amend your 941 reports, and you can get access to quite a bit of cash, which you'll see here in a couple slides. So they bumped up the employee threshold. I think it was originally 100, and they bumped it up to 500 or fewer full-time employees in 2021. Up to 70% of the first 10,000 of qualified wages paid per full-time employee per quarter. So that could be up to 28,000 per employee for the year. Okay. And then we got third round of stimulus checks. These ones were a little bigger, $1,400 per individual and dependents as well. So it bumped up that dependent one. And even your college kid got to claim the $1,400 bucks. Guesses about 2021 and beyond. There's a lot of uncertainty right now. We don't know if we think there's gonna be changes. There's probably gonna be changes. We don't know when they're gonna be if it's going to be 2022 and beyond or retroactive or anything like that. All right, so Biden's tax plan. First bullet, raise the highest personal income tax rate back up to 39.6%, up from where it's currently at, which is 37. More limitations to itemized deductions for high incomers. Further limits on like-kind exchanges, which those are those 1031 exchanges. What he's proposing is exchanges for gains, I'm supposed to say above, not about, $500,000 are disqualified. So bought a piece of property 20 years ago for 100 grand and now it's worth $1 million and you're thinking you're wanting to part ways with it, but you have another property that's like 1.2 that you want to roll those funds into, you have to pay tax on that. You can't do the 1031. Trump's qualified business income deduction. It's been a pretty nice tax break for our business owners. He's looking to phase that out. Expansion of the 3.8 net investment income tax to all sources of income over 400,000, including your active pass-through entities. So right now on your tax return, there's a form on there, your net investment income tax form. If you have dividends and interest and capital gains or anything like that, those get put on there. And then your pass through, say your business makes $500,000, that gets put on there, but then it gets backed out and you only pay that 3.8% on the actual investment income. This is saying that that's going to be included in there. He promises no tax increases for anyone making less than 400,000. Also, elimination of the step up in basis of inherited assets, which kind of could contradict the first one. Basically, right now, again, let's use 20 years ago, you bought a piece of property for 100 grand. You pass away, it's worth $1 million now. Your kids or whoever inherits that gets that new basis of $1 million. They could turn around and sell it tomorrow for no gain. With this, they turn around and sell it tomorrow for a $900,000 gain. They may not have been a high incomer, but now they are. So we'll get hit right there. Increased capital gains tax rate for those earning over $1 million. So we're talking up to your ordinary income tax bracket. So the 15% capital gains rate or the 20% plus your net investment income tax or your 23.8 tax rate on capital gains could go up to your ordinary income rate, which, as you saw on the previous slide, could be the 39. That's joint. And then if there's any C corporations that we have out here, increase the federal corporate tax rate to 28% from where it's currently at 21%. Increase the child tax credit to $3,000. I guess this would be more forward because this already happened for 2021, but that's only for 2021. I think this would make it more of a lasting effect. And then the $3,600 for the kids under 6. Expand the child and dependent care credit to $8 grand. Forgiveness of student loan debt. My girlfriend's really hoping for that one. Expand the work opportunity work credit again, and Focus on expanding access to retirement funding vehicles. And again, what we don't know is, or are they going to be retroactive? Probably not. So if there's things you want to get done, if you have a wish list now, probably look at getting them done. Okay, things to consider and the importance of planning. Consider, again, the employee retention credit. Can't reiterate it enough. If you haven't already done so, consider evaluating if you are eligible for the expanded employee retention credit. These credits provide real cash benefits, and the flexibility should make you at least, give you a good chance of qualifying for it. Filing amended returns, as I kind of touched on a little bit earlier. Evaluate assets placed into service in years after 2017 to see if they could potentially be fully deductible. That goes back to that that qualified improvement property. Use those deductions to create losses, because bonus depreciation can create a loss, unlike Section 179, and then you can carry that back 5 years and potentially recoup some tax money that you had already spent. Cost segregation studies. Consider performing a cost segregation study on acquired or constructed assets to capture as much depreciation as possible. Again, these deductions can be used to create a net operating loss that can be carried back to allow for more cash flow. Over the next 4 years, with the political environment being so thin margin, as we just talked about, wouldn't expect some major legislation in the short term, as we kind of talked about, but the Tax Cuts and Jobs Act provisions do expire in 2026. So at that point, things will go back to how they were. Kind of got ahead of myself a little bit here. Consider accelerating capital gains from installment sales if you believe that you will be subject to higher capital gains rate due to Biden's policies. So if you've sold something on installment and you're paying tax on that on a yearly basis based on the principal that you've received each year, you can actually go in and elect to just pull in the rest of the gain on in 2021, basically. So then you pay the tax at the 15% or 20% rather than a higher rate going forward. Sale of operations. If a sale of your business is on the horizon, I think now would be a good time to take a deep look into maybe getting that done now. If you have, let's say your business is valued at $10 million and your basis in this business is $2 million because you've been pulling cash out, that's $8 million of gain in a stock sale. So at the current rates, you're looking at, what would that be? 2.5-ish with state of tax. But if you hold on to it and sell it when capital gains rates are at ordinary rates, you could be looking at upwards of, between state and federal, 40, 45%. Inheritance taxes. One of Biden's primary focus areas is that step up in basis that we talked about. Consider gifting assets prior to these changes to avoid additional tax. Basically transferring that future growth onto whoever's going to receive that asset anyways. Good time to review your tax rates to make sure that your structure is the most efficient for your business purpose and distribution needs. Basically, if we need to shift how you're set up as a entity to save tax, that could be something we want to look into. Be proactive. We can't help you shape your tax outlook if you just bring your stuff in after the year end. When given the opportunity to meet for tax planning, don't hesitate. This is the most beneficial meeting with your CPA that you'll have all year. I typically try to go through every business client that I have starting in September, giving them emails, calls, letting them know I'm available to meet and plan with them. And even if there's nothing I can do to reduce their tax burden, at least they know in November or December what that approximately what their tax is going to be. So in April, when I call them up and say, hey, time to write a $100,000 check, they don't freak out. So, better to be prepared for it, and you can start, it gives you 4 or 5 months to kind of plan for that tax. That concludes.